Mutual fund managers have certain approaches to portfolio management: value, growth, momentum, quality, growth at a reasonable price, or maybe a mix of some of those. What do each of those styles entail? What is the element of risk? That's what I'm talking about today, or asking about today. But more importantly, should it bother you at all? Does it matter what you choose? Does it affect the outcome for you? So let's talk about this, right? Investment style. And these are necessarily, I think, the need for the investor to define certain things, and the need for the seller of a product to also define certain things, so it becomes easily identifiable. Is that the reason why you have these defined styles?
Look, I would say these are varying philosophies, right? Not necessarily you and I as a buyer kind of relate to them or pay so much attention to them. Actually, in my personal experience, I haven't seen many investors paying so much attention to them. Yes, few savvy ones do pay, but globally, these are acclaimed philosophies of being successful at the art of investing. You can't be everything everywhere. You have to choose your path. And as you rightly put out that analogy, so my analogy is there are many paths to God, and you choose the one which you like or which you think will be more agreeable to your own.
I like your analogy better. Frankly,
I think in Mumbai your analogy works.
You want to start the show again, we can start with that analogy. But having said that, no, let me ask you this. Let's define these styles, right? So that everybody's on the same page, and then we can talk about individual mutual funds and how they approach things. So value is something that a lot of people relate to. It's spoken about a lot because, frankly, over the long term, it generates such significant wealth, or has generated, for somebody like a Warren Buffett.
Absolutely.
Or certain other people. How do you define it?
Look, I think Warren Buffett or perhaps a Benjamin Graham are the known philosophers of this philosophy, right? So, and they've given fundamental rules, and they never go out of context. Basically, you're investing by virtue of finding reasonable value at a reasonable price. Now, there could be multiple parameters to it, depending from industry to industry, stock to stock. It could be earnings related, it could be book value related, it could be enterprise value related or EBITDA related, right? So, but the underlying philosophy is same, that you have to find some value or some merit in terms of allocating money, allocating your capital to fundamentally strong sectors or spaces where you think the valuation will grow because of the underlying growth or because it is currently undervalued. So